Welcome to the Wiser Wealth Management Roundtable. We believe the best financial advice should always be conflict-free. I'm your host, Casey Smith, guiding you to financial freedom. Or my co-hosts today, Jordan Sute and Matthews Barnett. Hey, guys.
Hi.
And gal.
Hi. Thank you.
How's it going?
Jordan's with us this quarter for all of our podcast on 10 important things to know about taxes. This can be found online, bottom of our website. Enter your email and download the white paper. Jordan's with Sute CPA and Kennesaw. So Thanks for coming in, Jordy.
Thanks,
Jordan. Sorry.
Thank you for having me.
Jordy, the combination of first and last name. Okay, so today we're going to talk about maximizing retirement tax savings for employees and business owners. And so I feel like there's actually a lot to cover on these topics. I want to break it up into a couple of segments. So we'll talk about employees. We'll talk about employees that don't have access to 401k plans and what they can do. And then we'll talk about the self-employed and what their options are. I will say that a lot of people sit down with us from the planning perspective and they say, well, how can I save more in taxes? I pay so much in taxes and they're making $300,000, $400,000, $500,000 a year. And when you're a W-2 employee, your options are fairly limited. The number one option is putting money away pre-tax. For younger people or people who aren't making, usually my cutoff, Jordan, you might have a different one, but my cutoff is usually around 150,000. Above 150, I think it's typically good that you put everything in pre-tax. And then below 150,000, maybe you split it part pre-tax and part Roth option.
Yeah, it's a no-brainer to save on taxes as the retirement plans at work. Yep.
So if you're thinking about this or you're looking at your situation even this year, another reason why we're doing this quarter is because these are all 10 things that we can do now to affect what we pay out in April. A lot of times people don't talk about taxes until January, February, and it's kind of a moot point.
Right.
By the time we get there. So if you're looking at your 401k plan, most 401k plans have an option of pre-tax or Roth. So let's be really clear about what a 401k plan is, we can be inclusive of all of our listeners who are just learning and those that are more advanced. Basically, you have a plan sponsor, which would be the company that you work for. Then you have a plan administrator, which would be the company that you're logging into, like a Fidelity or a Schwab or a TD Ameritrade or Empower or whoever it is that you're using. Then there's a plan custodian, which sometimes can be the same as the administrator. A lot of times it's not in the smaller plans. The important thing is that once you open up this account, you can put money into it to save for your future. The idea is that you would not get access to this money until after 59 and a half, and then you would be contributing a maximum of $19,500 a year. Plus, if you're over the age of 50, you can do another $6,000 per year into the plan. So
$6,500.
$6,500. Yeah. Thank you. So if we have a pre-tax option, that means every dollar that you put in on that side is not being taxed. So if you made $100,000 and you put $10,000 into the plan over the year, then you're really getting taxed on $90,000. Once you pull the money out in retirement, you then pay income tax at whatever rate you end up in retirement. Another option within most 401k plans is you have a Roth. So instead of putting money in and getting a tax deduction, you pay the tax. So if you made $100,000, you pay tax on $100,000, put money into the Roth side, and it grows tax-free forever. So that means you pull the money out, you don't pay any income tax on it.
And there's no income limits on that. I get that question all the time. I say, well, I think I'm above the income threshold. I can't contribute to it. And they get that confused with Roth IRAs, but not to be confused with the Roth 401k portion, which allows you to put that after-tax contribution in regardless of your income levels.
That's correct. People often confuse the personal Roth IRA from the 401k Roth. We get that a lot. Some larger companies will have an after-tax option as well. So let's say you've maxed out your 401k and pre-tax and Roth at the 19.5. You could put additional monies into the plan after tax, not to be confused with the Roth version. Larger companies we see quite often you have pre-tax Roth and then after-tax, and people get confused between the Roth and the after-tax version. of that. But there isn't a maximum amount that can get into a 401k though.
Right. So that after-tax max or whatever the additional contributions would be can't be above $58,000 for an individual under 50, and then you have catch-up contributions for those over 50 to where you could contribute up to $64,500 annually into a 401k plan.
And then at Wiser, we work a lot with the aviation community. So you see that often airline pilots are getting, in most cases, all the majors anyway, anywhere from 13 to 17% of their income is contributed for them, defined contribution, into the 401k plan. So that money goes in always pre-tax. It doesn't go in post-tax. So that's tax-deferred money that goes into the plan. And then you put your 19.5 in, and there's a threshold at which that match plus what your contribution is would exceed that maximum amount into the 401k. Because very often people go, how would that ever happen? And pretty much it's for the airline pilots, it's contract negotiated through the union, and for the rest of us, it'd be generous employers.
There's not a lot of 16% matches out there.
Yeah,
no, there's not.
crazy.
And the match is kind of industry specific, I feel like. In the airline world, that's pretty common. But you remember there used to be pension plans, and after the financial crisis, a lot of airlines went belly up, after 9/11 for sure.
Right.
And then the pension plans went away, so this got put in place of pensions.
Well, that's the advent of all these retirement plans, is everybody used to rely on pensions, and it was provided by the employer. Now it's on the responsibility of the employee to not only just for tax efficiencies to make these contributions, but to supplement your own retirement, which is kind of the purpose of these as well.
True. All right, so we understand that now. Now let's switch gears. A lot of times, high-level executives within a company have access to deferred comp plans.
Right.
So a deferred comp plan is typically set up where it's separate from your 401k plan. You're making $300,000-$400,000 a year, and you want to defer money. And typically, I think it's up to 50%. The comp plans are written for each specific company. There's not I don't think there's a boilerplate deferred comp plan that I've seen. You could defer up to $100,000, or you can defer as much money as you want, typically up to 50% of your deferred comp. The issue is at the time you put the money in, you have to determine how you're going to pull it out. So typically it starts at separation, and you'd have lump sum, 3-year, 5-year, 10-year. So if you contribute $1 million to it over your time at the company, you separate from the company, immediately it starts at 3, 5, 10-year or the lump sum.
Right.
If you leave the company early, it also triggers 1, 3, 5, or 10 years, not age-based necessarily. A couple of gotchas with deferred comp plans. Unfortunately, the ones I've been involved in with clients have all ended this way. Company merger. So the company gets bought out by another company. Basically, it's an IRS rule and how it's structured, but that comp plan has to be liquidated. So when that comp plan gets liquidated, you're now working at $300,000-$400,000 a year, and you just had to take on another large payment. So that part has been a surprise every time, and it kind of stinks. Another one which we have not witnessed, but I know that it happens, is you have a company that's going out of business. So if you have a large company, you're part of a large company, you put into a deferred comp plan, they shut down. That money's not yours. That money stays with the company. So that's
worst case scenario.
It's the worst case scenario. And that's something you have to think about when you're doing a deferred comp plan, is what is the health of the company. Now, the good news is typically the people who have access to these plans are near the C-suites or in the C-suites of the company. And so they should have a pretty good idea of the fiscal status of the business.
Right. And just looking at this from like a tax W-2 perspective, any of these dollars that you're deferring pre-tax, so either your 401k contributions or deferred comp, you're still paying all your payroll taxes on it, but it's not going to show up on that box 1 to be subject to federal income tax or state income tax in the year you defer it. And so that is the only piece that you'll end up paying when it comes time when you earn it.
Income.
Mm-hmm. Yes.
Right.
Yeah.
Matthews, pre-podcast, you had another one, good idea, HSAs.
Yeah, so it's often overlooked aspect. Some people don't even know what they are. If you have a high deductible health insurance plan through work, you can contribute to a health savings account. It's usually used it's one of the few things that has triple taxation benefits. So just like these 401ks, you get the deduction for your contributions up front. Funds can grow tax-free, and then they're tax-free when withdrawn for qualified medical expenses. So a nice little benefit there. The contribution limits for this year were $3,600 for an individual or $7,200 for families. And then if you're over 55, not 50 for these, you can make an additional $1,000 contribution as a catch-up. So nice little benefit here. They also have the advantage of if you're over 65, you can actually access this, not tax-free, but without penalty. So you'd pay income taxes on the withdrawal, but you'd avoid a penalty after age 65 if you use these as a kind of like another IRA supplement.
That's a good idea.
And a lot of companies have it where it's not use it or lose it. So you can roll it from year to year and it grows in value and you have this massive tax-free pocket that you can pull into for medical expenses.
Yeah, that's a good point. I think people get confused with FSA where they think they have to use it. And, you don't, just because you're contributing to it doesn't mean you have to use it. You can allow that to grow for future contributions or for future expenses.
Yeah.
All right, let's shift gears. Let's talk about people who do not have access to a 401k. Probably various reasons for this. It could be it's a startup company. It could be the company's not in the best financial shape, but for whatever reason, you don't have access to that. So really there's two immediate options that come to mind. One is a traditional IRA and the other one is a Roth IRA. Now you're subject to income limits, contribution limits. So in the 401k, where you could put in $19,500 or plus the catch up if you're over age 50. In an IRA, the max is going to be $6,000. The catch up was another $1,000, so $7,000 if you're over the age of 50. The money goes into an IRA, pre-tax, so it's like you didn't earn the money. The Roth is the same way, or the same version is in the 401k, where you pay the income tax, but then it grows tax-free. If you don't have a 401k, so you and your spouse don't have access to a 401k, you can deduct that. There is no income limit. However, there are income limits for the Roth. Some people want to max out their 401k and then save in a personal Roth as well. And those income limits are $198,000 for joint, $125,000 for an individual.
The 198's phased out too, so you could still contribute. It just wouldn't be the full 6,000.
Right.
But then it goes up to, I believe, 208 or somewhere around there.
Really quick phase out.
And then it'd be a cliff to where you couldn't contribute.
Yeah.
So those are really your only two good options. Other people might try to sell you like an annuity. I'd stay away from those. Those are expensive, especially the insurance-based annuities. There is a third option, which would just be a regular brokerage account. Just put money into a brokerage account. We actually have a program called Flight Path that we have quite a lot of people actually use it for supplemental savings. In the Flight Path program, we're able to use low-cost index funds, keep the cost below or at 0.5% a year. So it gives them a good option for saving for outside of 401ks or outside of IRAs and Roths if they don't have access to 401ks. So you can do the same thing. I'll say across everything we're talking about today, the idea is you want to have access to low-cost index funds. That's important. Stick with the low-cost index funds. Stay away from active management, individual stocks overall. All right, so if you don't have access to a 401k, we have IRA, a Roth, and a brokerage account as an option. Now let's shift gears again and let's talk about the self-employed. This is where it gets creative, right? So just think about taxes in general. You have a lot more strategies and tools in your tool chest for business owners versus you being an employee. So talking to all the business owners, the self-employed, if you're wanting to save a lot, the number one go-to is a solo 401k. So solo 401k, no brainer.
Right.
You can put in $19,500 a year. You open it up similar that you would to a 401k, and then you can put an additional 25% of what your income is into the plan, up to the max. So that's a great way to save, $57,000 a year?
58.
58,
yeah. And
then what's the catch up? 6?
So that's 65, so it gets you to 64,500. Nice little benefit. A lot of people don't even know about these. They think SEP or Simple are the only options or just a regular 401k, but very similar in the way they're set up when they're contribution limits. They're also a lot more cost efficient and they're fairly easy to set up.
What I like about it is a traditional 401k could be $400, $500, $600 a month to administer, but you can open up a solo 401k with no administration fees. So for our clients that do this, we use TD Ameritrade, and there's no admin fees. So it's just like open up an IRA account. It's a very simple couple pager plan policy statement, and off you go. So that's a great way to be able to defer a lot of income.
And a good thing about the solo 401ks is if you have your spouse who doesn't work, they could participate as well. So you can, if you have them on W-2, whether in your S Corp or if you're a partnership together, you can put them in the 401k as well for you and your spouse.
Do you get the $57,000 each or $58,000 each?
Yes. Yeah. You get the 19.5 and then the employer match. Yeah.
That's a great way to save. Yeah. Why wouldn't you add your spouse and just pay him at least that?
Exactly. Yeah.
Go ahead. Oh, nothing? Okay.
No, well, I was going to say, I mean, we get that question a lot about why wouldn't I do a solo 401k then? And the reason is, you mentioned the spouse, you and your spouse can, if there's a partner, or you're allowing them to contribute to the plan. But if you bring on additional W-2 employees, then you actually lose the capabilities of contributing to solo 401k. So if you're just the only employee, it's great to do because it has the highest contribution limits. But once you bring on those employees is when it becomes an issue.
Right.
Yeah, no, that's a great transition. That's where I was headed. So yeah, you hire your first employee, solo 401k doesn't work anymore, and you have to have a normal 401k. I'm going to get in my soapbox for a second. One is, if you're going to do a 401k, do it right. I mean, this is how I look at it. You have people working for you that are helping build your business. You couldn't do it without them, or they wouldn't be there, right? And I see so many times employers, they just, it's like they don't even appreciate the fact that they should be helping the people that are helping them. And so what happens is they get cheap, and maybe that's how they're successful. They've managed every single penny, but they get cheap on the 401k plan. And what happens is they get a salesperson who says, hey, I can set one up for you, it won't cost you anything. And what they're doing is they become the vehicle to where they're helping this product pusher take advantage of their own employees. And so what I see are insurance-based 401k plans. I see brokers. We all know them. They're on all the corners. They come in and say, this is a free plan. So they set up this free 401k plan. Administration fee is all paid for by the employees. And then immediately when the employees invest, they go, well, I just lost like 4% already. I just put money in like yesterday. And that's because they're collecting a 4 or 5% fee on the front end of every single investment going into the plan. The fund typically has all the same fund companies, like American funds. Not that American funds is necessarily bad. It's just how the 401k is set up. So what I've seen is 2 to 3% fees every single year, plus these front end fees. And you're treading water from the very beginning, but yet you offered a 401k plan. And at that point, don't even do it. I wouldn't even offer a 401k plan. There's no reason to give people a sense that you're helping take care of their future when you're really just robbing from their future. You're the vehicle to do that. Now, I don't think any business owner intentionally does it that way. They just don't understand, and they don't know where to get good advice. So if we're going to do a 401k plan, this is how we set it up. The business owner pays the admin fees. The business owner pays for our fee directly. It's a flat fee. We bill it every quarter. And then the employees, the people who are helping build the company, build the empire, right? They pay the lowest rate possible. Their fee should be under 30 basis points or 0.3%, in my opinion. Otherwise, why the heck do you have one? Why the heck do you have a 401k plan, right? Just to check a box.
Right.
So, that again, that's my opinion. And there's very successful business owners that I know that don't see that yet. I see them on social media and taking trips of a lifetime every other week, and then their own employees can't even get matching because they're too cheap to do matching. And they're trying to squeeze maybe a certain yield out of the company. But I don't think that starts with the employees. I think there's other ways that you can do that. Anyway, that's my 2 cents. So if you're an employer, you want to go build a 401k plan, my suggestion is that you do a safe harbor plan. So a safe harbor eliminates you from all the testing, because what can happen in a business is you have an employer and maybe 1 or 2 people that are making most of the money in the company, or most of the salaries in the company, and then you have other people who are lower paid employees. What happens is if they don't participate, you can't force people to participate. You can create a great buffet, but it doesn't mean that anybody's going to eat it, right? So we can create a great plan with 3 or 4% matching. It doesn't mean that they're going to participate. But you can do education. That's something that we do with our 401k plans. You go in once a year and it's like a pep rally. Get them all going. Bring them Chick-fil-A and say, this is why you should save for your future. But the idea here is if you don't do a safe harbor plan, you may not be able to contribute to the maximum for yourself. So if you want to put in $19,500 a year, if you have a bunch of other people who aren't participating, then you're going to end up not being able to do that. We have many clients who are employees at firms that are highly compensated. One of them paves roads. They put roads in. And you have a lot of workers, a lot of laborers there that are on salary at the company. They don't save anything. And you have 100 of those and you have 20 managers. Next thing you know, those 20 managers can only put $10,000 a year into their 401k plan because there's so many people not participating. So if you do a safe harbor plan, what that means is you're committing to matching 4 to 6% a year. So that's your range you can contribute. So you'd match 100% up to 4 to 6%. If you offer that and then nobody participates except for the highly compensated people, you can still do the maximum. So that's important. And it just makes it a lot easier not having that testing done every single year. You also can do profit sharing on top of that. Profit sharing is for everybody. There's 3 types of profit sharing. I don't want to go into necessarily that much detail today, but basically you can do it based on age. You can do it based on a flat percentage, or you can do it based on like groups. So more highly compensated people would get more. So you can do a profit sharing plan, which is really the only way. Let's say it's 2021 now. In 2022, I could write a check for profit sharing for 2021 and then lower my expenses on my books, right?
Right, yes. It's a great tool to get the tax deduction back in the previous year.
And I believe that's probably about the only legal way to change your books after the end of the year.
Yes, by April 15th. You have to do it by April 15th, but yes, agreed.
Does that include all the extensions that's been added? So if we get until October 15th because of COVID, it's still April 15th probably?
Probably, yes, I believe so.
To close out the corporate books? Well, it probably has more to do with the corporate deadline.
Yes.
Okay. So yeah, so we have the profit sharing option. So you're a business owner, you open up this 401k plan. I would expect the cost to be between $400 and $500 a month. Might be ways to get that cheaper. You would have 100% match up to 4 or 5%, and then you can set your vesting period. So people at my firm, this is the wiser employees, we have a matching 100% up to 6. We have profit sharing, and then we also, I think it's a 6-year vesting schedule. So you have to be here 6 years to get the full 100% of that match. So that way you get some buy-in on longevity, and then you have a match to help people in their saving for their retirement. So if you don't want to go to the extent of a 401k plan for your business, I think the baby step for that is probably the simple IRA. So the simple IRA is literally is its name. The acronym, I don't have that written down.
Yeah, it's a long one.
It's all caps.
Yes.
Simple, SIMPLE. Maybe that's a bonus. Someone wants to mark on the page what the simple means. All right, so the simple IRA, you have 2 choices. You can put in 2% for everybody, or a 3% match. Those are your 2 choices. There is no administrative fees. You can open it up, simples up at pretty much any brokerage account. I will note that if you do it through your payroll, so our payroll here is done through ADP. Great people, love the company. But if I wanted to do a simple IRA, they're going to charge quite a bit for each person in the plan. No reason to do that. With ADP, probably with other carriers, other payrolls as well, you can set up an automatic deposit where it's already calculated how much is supposed to go into the simple, and it'll automatically, through ACH, send that to the brokerage company for a deposit. So you can get it very automated, and it would not cost you anything per month. This is probably where most employers should be if they're concerned about the cost of a 401k plan. Just come back to the simple. Now, the caveat is the max you can put in is $13,500.
Right. With a $3,000 catch up for those over 50. So much lower than the 401k. Yeah.
But it's a great baby step. You start there. People are participating in the plan. You can tell people appreciate the plan. then you can move into a full-fledged 401k plan after that. We had a company with 30 employees do that recently. Did the simple for 6 months, and then they immediately switched over to the 401k.
And you have to move to 401k once you hit 100 employees. Simple is for less than 100 employees.
That's a good point.
Yeah.
That's why we have you here, Jordan.
Great.
So another option for 401k is a more advanced 401k. So you come out of the testing, meaning that maybe you're not concerned about people not participating, and this is where you can get the match to be bigger in the 401k. Because if you want to match like at 10%, that can't be a safe harbor 401k. It's going to have to be something very different. But you can customize those documents with any third-party administrator to be able to do pretty much anything you want within a 401k as far as matching goes and vesting and all that. Just you're now subject to testing. So if you're in a professional work group and most people are participating in the plan, maybe most people are equity owners in the company, that might be another way to defer more money. Is through a more aggressive 401k plan. One thing that we need to jump back to for self-employed is the SEP plan. This is probably about as close to a pension as you can get for a small business these days.
I think it stands for self-employed pension.
It does, actually.
There we go.
So who has the details on that, on a SEP? What's the max I can put into a SEP IRA?
58. Just like the others, but it's 25% of income. So you have to work up to that 58. You can't just put in that 58, and it's through employer contribution. So really it's the business making the contribution for you. It's not necessarily the employee making the contribution. And we see this a lot of times with like Schedule C taxpayers. So you're self-employed and it's on your 1040, not necessarily on your business return, although it can be done on your business return as well.
But you can use business money. That's the important part.
Yes, correct.
Right.
And the good thing about the SEP is that say you have a W-2 job where you participate in your 401k. If you have a side, Etsy business or side gig, you can still participate in a SEP while also participating in the 401k.
That's great.
Yeah.
So you can defer 25% of your side business income, would be your total income.
Right. Yes, correct.
Into a SEP.
Yeah.
And so there's no matching, same easy setup. There's no 401k, or there's no like a 401k where you have monthly admin cost. There's no setup fees for SEP or maintenance fees. You can open those accounts free online very easily. Okay, good point. So I think just in summary, I'll add that in all of these investment options, we want to use low-cost index funds. They're very easy to get a hold of. Most brokerage companies you're opening up 401ks with are all going to have index funds with costs less than 10 basis points or 0.1%. And when you're building a 401k for your company, you want to make sure you limit your options. There's a lot of maybe more cool looking titles that of mutual funds you can put into a plan. Really, you just need total U.S. index fund, total foreign, and a bond fund. That's really all you need. So just be careful of fees that are on the back end. And the person selling you a 401k plan, make sure you understand the fees. You have a fiduciary duty to do that as the business owner. So when you're choosing your plan, you're in charge of that plan. Even the big companies a few years ago, they screwed this up and did not offer the best available pricing in mutual funds to their employees. And there was a class action lawsuit and they lost. Lockheed here in Marietta. That was the first one that I realized that happened to, because we had clients coming back in with these checks, actually pretty good sized checks. So you want to be careful that you're working with a professional advisor who's also a fiduciary on the plan, not a salesperson, but a co-fiduciary on the plan, to go and build the plan out to make sure it's in the best interest of the employees, because you as the employer are in a position to take advantage of them, and you don't want that to ever be the case. So work with a fiduciary advisor, because you are a fiduciary by default as a business owner. Now you can defer that. You can defer that fiduciary to the advisor themselves, where they're in charge of the plan. You kind of wash your hands of that. That is an option. But just be careful in your construction of 401k plans. Anything else to add?
I think we covered it all.
All right.
Enjoyed it.
Good conversation, guys. We'll see you next time.
Thanks for listening to the Wiser Roundtable podcast. We hope you enjoyed it. Make sure to subscribe wherever you're listening. That way you don't miss out on new episodes. Head to wiserinvestor.com and reach out if you have any questions. We would love to hear from you. Today's episode was produced and edited by Lilton Moore.